So I'm going to make this a short and sweet episode, and you are going to leave today knowing exactly what you do need to report to the IRS and what does not actually count as income to your business. Welcome to the Sunlight Podcast. In this show, we're talking about taxes, money, and careers for self-employed people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, and the founder of Sunlight Tax. If you're a creative or soul-centered entrepreneur or wellness practitioner who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your time and have a bigger impact with your work, you are in the right place. Hello. Welcome. Today I want to talk about what actually counts as income. People get really confused sometimes because it's not actually always clear what income you need to be reporting on your tax return. So let's be clear about what the rule is. When you run your own business, when you're self-employed, and when you file a Schedule C, it is your legal obligation to report all of your income derived from that activity, okay? You cannot leave off cash or small amounts of money that weren't reported on a 1099, for example. That is illegal, right? We don't want to break the law. So, and also just to not to put too fine a point on it, but if you understate your income to the IRS by more than 25%, you're committing a felony. So let's be super clear. These sort of cutesy words that people throw around, under the table, etc. The IRS is like, no, we say felony. You say tomato, we say felony. So let's just be super clear. You got to report your income. So to all of you well-meaning people out there who want to do right, what actually counts, right? Sometimes something that seems like income actually isn't. And sometimes things you might not think are reportable income are. So I'm going to make this a short and sweet episode, and you are going to leave today knowing exactly what you do need to report to the IRS and what does not actually count as income to your business. Let's jump in. Okay, what does count as income? Grants count. Grants are reportable income. I do on occasion get a client who will say to me, hey, the granting agency said that this isn't taxable. And to me, the answer back is ask that granting agency to provide you a letter citing the part of the tax code that says that the grant you received from them is not taxable. If they can provide you that letter, great. You don't need to report it. In all other circumstances, barring your receipt of that letter, that is reportable income. And I do not care what that agency says to you. I want proof, not just a verbal reassurance. Okay? Because the assumption is going to be a grant is reportable income and you're breaking the law if you don't report it. So you better have a letter that says, I definitely know for sure I'm following the law when I don't report this. Okay? So there's grants. Cash. You know this. Cash is reportable income. You could have a business that operates entirely in cash. And of course, that still is your income. It doesn't matter, right? So, a lot of people sort of believe falsely that cash somehow you don't have to report. Or, frankly, there are people in the world who sort of try to operate in an under the table way and don't want to report cash income. I'm just here to say, the IRS is not stupid. I personally can think of ways that I would set up my algorithm if I were the IRS to detect unreported tax income, cash income, and it's not that hard. And believe me, the IRS has a whole program. I believe it is called the Buried Treasure Program. And it is all about sniffing out unreported cash. So I just want to warn you that cash is very visible. It's very easy. Once we subpoena your bank records, you're caught, right? So just make sure you stay on the right side of the law and always report your cash income for your business. All right. What about those third-party apps, right? Payments through Venmo, PayPal, Cash App, Zelle, checks, credit cards, things like that. That basically it counts as income, right? It's income. So it doesn't really matter how the money comes into your business if it's a function of the operations of your business. Most of the time, it's considered income to your business. All right. Now, one little exception here, for example, when we're talking about Venmo, is if you're reimbursed for personal things, right? You and your friend go out to dinner and you foot the bill, you intend to both pay your own way, but you foot the bill because your friend didn't have Venmo or whatever. You pay the bill and then they Venmo you their half of the meal back again. That does not count. That is not income to your business. All right. And I'm going to give you a metric in a minute to just sort of show you how you know the difference between what does and doesn't count. But that specific scenario is one I see a lot. And no, that doesn't count as income to your business. You do not need to report that. All right. And then lastly, what counts as income is amounts paid to you even when they're not reported on a 1099. Every now and again, I have someone ask me, assume that because they made income in their business that was in an amount under $600, AKA under the reporting threshold for a 1099 as a contractor, they somehow think that this means it doesn't count as income, that they don't have to report it. And no, that is not true. You definitely do, right? You could make all of your income in your entire business in amounts that are smaller than the 1099 reporting threshold. Does that mean you don't report any income for your business? Of course not. You know this is true already. I'm just going to remind you. But here's the other side of this coin. What does not count as income to your business? What are you not taxed on? Well, first and foremost, gifts. If it's a gift, it isn't taxable income. So if you are in the lucky position where, for example, your parents pay your rent, that's a gift from your parents. That is not taxable income. You do not have to pay any taxes on that whatsoever. I do want to say, though, gifts are defined and scrutinized by the IRS. So don't make a mistake of, if somebody wants you to do work for them and they give you money and they call that money a gift, that is not a gift. If the person asks you for anything in exchange for the money, it's not a gift. It is payment. Okay. The IRS is super clear on that rule. So be careful there. Here's another one though, loans. When you get a business loan, you get a loan to your business, that is not reportable income. And if you think about it, it makes sense because it's not your money. It's cash in your bank that you can use for a time period, but it's not actually income to your business, right? So loans are not taxable income. The last one is when you move money from your personal account into your business account, right? Let's say I don't have enough funds, enough cash in my business account to cover a big upcoming expense. I can move money from my personal account into my business account to cover that expense for a moment. What I'm doing effectively is giving my business a loan from my personal bank account. It doesn't count as income. On the flip side, when you pay yourself, just FYI, paying yourself, doing an owner's draw from your business account into your personal account, that also doesn't count as an expense. So this one works in both directions. It's neither income to your business nor an expense of your business. When you move money from one of your bank accounts to another, you're just moving money from your pocket, your left pocket to your right pocket, right? The IRS cares, is it in your pocket, right? You with your social security number. That's the pocket we're looking at. We don't really care which pocket it's in. We care, does it belong to you and your social security number? All right. Okay. So here's a metric that should help you make a determination in all cases about whether income you receive is actually taxable income or not. So here goes. Is the money you bring in a function of the business itself, right? Is it income generated by the operations of that business? And I want to clarify what I mean when I say that. If I'm a pizza restaurant, right? Income that is a function of the operations of my business are pizza sales, basically, right? Maybe some catering, maybe I have a couple lines of business. But if I make money in one of those two ways, that is business income for sure. If I get a loan from myself, that's not income to my business. If I get a loan from a bank, also not income to my business. Right? So if it's from your operations, yeah, it's reportable income. If it's not from your operations, it probably isn't. Of course, you want to check every individual case, check it with your tax accountant, et cetera. But in general, that metric should help you understand when something is income and when it's not. Now, let me give you a couple scenarios that I see a lot with people that I work with that people ask me questions about. So I hope these can clarify for you a couple areas where I see people get into a little trouble. So sometimes you work with other people, you do something with other people, and you hold the money. If you act as the treasurer for a group activity, I want you to know that the IRS is looking at who's holding the money. That's kind of where they make decisions, right? Whose bank account, whose social security number is on the bank account the money went into. That's who's going to get taxed. Okay. So I'll give you one scenario. Let's say you're in a group that works together. For example, you're a musician in a band, right? You got 4 bandmates, you go play gigs, you maybe teach lessons, etc. Right? So when you have a gig, if you're the treasurer, you will get paid by the venue through about, ticket sales, fees, whatever. You'll get paid from the venue on behalf of all of the members of the band, but you hold the money, you put it in your bank account, and then you pay out the band members their individual shares. Well, you are going to be on the hook because that money goes into your bank account. You are the one on the hook for that income. But on the flip side, you should also be the one paying out your bandmates because that makes you then get the corresponding expense. In other words, you will net out the income, right? So yes, you took in the $1,000 each for each of your bandmates that they earned. So you will be taxed. You're going to be reporting that, $4,000 extra dollars that aren't really your money, but then you pay out that $4,000 to your bandmates. So it counts as an expense to you. So in other words, what's sitting left in your bank account is zero, right? The taxable income on that is still zero. It does mean you need record keeping. You do need to track that. You do not want to forget to report that you paid your bandmates because the IRS is not going to forget that you earned that income. Okay. Here's another scenario I see. Sometimes I see this is the function of the people that I serve. A lot of you are out there doing these incredible, wonderful things, especially, for example, when we get into political season, when there's a presidential election or an important midterm, I see a lot of my clients running fundraisers. I have in the past had clients who designed their own t-shirts and sold them to benefit and donated the funds to a political candidate, right? P.S. You don't get to take a deduction for political contributions. Much as I wish you could, you just can't. So that person who's doing that fundraiser, unfortunately for that person, income that they receive for printing those shirts is simply going to be counted as business income. I know that doesn't feel right. And I know that the thing you're doing is generous in spirit, but that is just how it works. The money is coming into your bank account for an activity you're doing. You are going to have to pay income tax on it as though it was taxable income, even if you're donating that money. Okay. And for this client in particular, she was like most clients that I work with, she did not itemize. She took the standard deduction. And if you've listened to past, my episode on the difference between itemized deductions and business deductions, you know that itemized deductions includes charitable contributions. And only 10% of US taxpayers itemize. So only 10% of US taxpayers actually get any deduction at all for charitable contributions. So this is sort of a really sucky whammy when you're doing a fundraiser and you donate money and you don't itemize. You don't get any deduction, but you do have to count the income. I know it sucks. I didn't make that rule. I'm just telling you about it. I will tell you this though. If you're going to donate that money to a nonprofit, one, then it could be deductible if you itemize. Now, again, you want to be sure that you check your last year's tax return and see if you're an itemizing taxpayer or if you're someone who takes the standard deduction, because I want you to be very clear that you do or do not get your charitable donation amount as a deduction on your tax return. That's important. But I will say this to you as a workaround for those of you who may do charitably oriented projects. This is the whole role of a fiscal sponsor. This is one of the benefits of going through. Yes, it's a lot more work. I'm not going to lie. You can't just like spin it up overnight. But if you have a big project and you're planning on using a lot of money, a fiscal sponsor can save you from this headache, because essentially the role of a fiscal sponsor, they are usually operating as a 501c3 nonprofit. So when donors give to them, they do get a deduction for that. Of course, only if they itemize, not if they don't. But they get a deduction. The fiscal sponsor is the one holding that money, so they are not taxed, or so you are not taxed on the money. And the fiscal sponsor, yes, when it pays out money to you, yes, that will count as income to you, okay? As any money that is coming and hitting your business bank account is going to, generally speaking. But you could do some timing around like when they give you that money this year versus next year, when it's a little more advantageous to you tax-wise, when you have a corresponding expense coming up. So you can do timing stuff with a fiscal sponsor that's a lot more sophisticated and is basically going to help you prevent having a big tax whammy from basically doing something really awesome in the world. All right. So remember, the metric I shared with you today is basically, is this money coming into my business bank account as a function of the operations of my business? Generally speaking, when that is the case, then yes, it's taxable income. Is it a payback for pizza night or my friend paid me back for a meal we shared? Then no, that is not taxable income. Gifts, not taxable income. Loans, not taxable income. All right. So I hope that that clarifies for you some of the tricky scenarios you might get into, but also just a baseline for what does and what does not count as your taxable income when you're self-employed. All right. I hope that helped you all. Send me a message on Instagram at Sunlight Tax if this was helpful to you. And of course, let me know if there's a topic you want to see in a future podcast, and I will see you next time. Bye. Thank you for listening. If you like the show, be sure to subscribe, leave a review. It really helps, and share it with a friend. I'm so grateful. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links we reference at sunlighttax.com/podcast.